Welcome back to Patrick Boyle on Finance. Today's video is a bit of a follow-up on a video I did back in September explaining what SPACs are and why they suddenly became so popular in 2020. In the video, I argued that they're not a great deal for either investors or for companies wishing to go public. I also mentioned that an alternative to going public via a SPAC was a direct listing, but that direct listings are not suitable for a lot of companies who need to raise capital to run their businesses. Just before Christmas on December 22nd, the SEC made a rule change which may bring an end to SPAC Mania. In today's video, I'll explain the new rule and we'll talk a bit about Roblox, who cancelled their IPO and announced on Wednesday that they were going to go public via direct listing. Okay, so as a quick recap on my SPAC video, in case you haven't seen it, SPACs are an idea that's been around for a really long time, but they suddenly became really popular in 2020. A SPAC, which is sometimes referred to as a blank check company, is a corporate shell that goes public by issuing shares and raising money from investors with a plan to then find a private company to merge with. Once the merger happens, the target company is now public, having avoided an IPO. The SPAC is a publicly listed shell entity to begin with, meaning that it just contains cash, but no operating assets, so there's no running business, it's just a company with cash. It then buys another company using that cash, and so post-merger the cash has gone to the target company, and the SPAC now owns a portion of that operating company, which is now publicly listed due to the merger process. There's an awful lot less scrutiny in this process than there would be in a typical IPO, and for that reason there's been a lot of controversy with companies like Nikola, Luckin Coffee and Wirecard having gone public via SPAC. And it's kind of unlikely that these companies would have made it through the due diligence process that is typical in a traditional IPO. Now, I argued in my prior video that the reason that SPACs became so popular in 2020 was due to WeWork's failed IPO last year. WeWork filed to go public, pitching that they were worth $96 billion, and they were essentially just laughed out of the room by institutional investors. The IPO ended up failing, and this was at a time when WeWork really needed cash. This left them on the brink of bankruptcy and caused the co-founder Adam Neumann to resign. The WeWork debacle, combined with some other unicorn IPOs being a bit soft around the same time, frightened the tech unicorns, who suddenly saw the SPAC as being the best route out of the enchanted forest and into the world of publicly listed companies. We were told that IPOs were now over and would all be replaced by SPACs, but as I explained in September's video, the fee structure of a SPAC meant that the sponsors and banks were getting rich, but investors and companies were perhaps getting quite a bad deal. So why might SPAC Mania now be over? Well, the SEC announced, as I said earlier, on 22nd of December, that it had approved a New York Stock Exchange plan for what they call primary direct listings, where companies will now be able to sell shares directly on the exchange to raise capital, and that's something that has not been allowed before. Up until now, direct listings have been used by companies whose founders or whose early investors wanted to cash out by selling their own stock, but they didn't work for companies who needed to issue new shares and bring in capital to grow the business. So companies like Palantir and Spotify used direct listings to go public, and this wouldn't have worked for WeWork, who actually needed to bring in new capital just to operate the business. The SEC allowing this new approach comes after months and months of negotiation. The Council for Institutional Investors, which is a group that represents major pension funds and endowments, objected, arguing that the plan eroded investor protections and might make it more difficult for shareholders to sue over material misstatements or omissions made during the IPO process. Now that the SEC is allowing firms to raise capital through direct listings, both critics and backers agree that direct listings will become significantly more popular, and they definitely are an alternative to going public via SPAC, where around a quarter of the money is eaten up by fees. And if you want to see how that's broken down, do watch my earlier video. Now, the New York Stock Exchange claims that this is a game changer for our capital markets. It's leveling the playing field for everyday investors and providing companies with another path to go public at a moment when they are seeking just this type of innovation. So will direct listings replace both SPACs and IPOs? Well, obviously startups and venture capitalists will like the idea of direct listings, hoping that there will be less of a gap between the offering price set by bankers and the pop that frequently occurs on the first day of trading. As an example of a big pop, Airbnb went public with a traditional IPO last month. The shares were sold, I think, at $68 a share to those who got allocations. And then the shares opened the next day on the exchange at $146 per share, which is more than double the IPO price. And that meant that the company and its early backers possibly missed out on around $4 billion, with the professional investors who got allocations reaping that benefit. Now, this sort of thing wasn't avoided in the world of SPACs either. When Nikola, the gravity-powered truck company, went public last year via SPAC merger, Nikola backers got $10 per share, so the company owners got that $10. But on the first day of trading, it closed at $33.97, once again leaving a lot on the table for those early investors. So a big question then is, will direct listings bring an end to investment banks' lucrative IPO business? I don't think that is entirely likely, but even if banks don't underwrite direct listings, they'll still make fees advising companies that go public and helping them with the listing. Palantir, for example, that went public in September of last year via direct listing, paid out tens of millions of dollars in investment banking fees as part of its offering. So how do these new primary direct listings actually work? Well, under the new plan, once trading commences, new shares being issued by the company will get priority over secondary ones being sold by early investors. And this is so that companies reach their fundraising goals first before insiders are able to cash out. Venture capitalists have long advocated for greater use of direct listings, in part because the arrangements don't require investors to wait for lockup periods to expire before they can sell their shares, and that's what happens usually with an IPO. So what's going on with Roblox and their direct listing? Well, the Roblox direct listing was announced on Wednesday, and it's a rare example of a company publicly switching from a traditional IPO to a direct listing. It is, however, a standard direct listing. It's not one of the new primary direct listings, so we're going to have to wait and see who the first company to do that will be. Roblox, which is an online gaming company, had originally filed for an IPO that advisors expected to occur last year. It would appear that they possibly changed course after seeing Airbnb and DoorDash experience large first-day trading pops. The CEO of Roblox explained to employees and early investors that we feel there is an opportunity to improve our specific process for employees, shareholders, and for future investors. So why do traditional IPOs actually pop? Well, investment banks aim to price an IPO at a valuation that feels reasonable and is in line with the valuations of similar existing public companies. But they need to leave enough of a discount so that people who buy the stock in the IPO can expect to make a bit of money. They need to get investors enthusiastic, essentially. The bankers want the stock to pop a little in order to reward investors for taking the risk of buying stock in a new unproven company that has not traded before and that may have uncertain prospects. They encourage institutions to invest by giving them attractive pricing, lockups, good corporate governance, and all these other things that investors look for. The reason that investors do line up to buy IPO shares is that they typically pop in price. If instead they just sometimes rose and sometimes fell and were a bit random, big investors might just stay on the sidelines and wait to see a few quarters of earnings before deciding what to do. And of course, this might make it quite difficult to sell large blocks of stock. So the discount does make some sense, and it's just really about how well banks price these IPOs. Now, last August, Andreessen Horowitz, the venture capital firm, wrote a piece on IPO pops, and in it they argued that they are mostly an artifact, not of mispricing, but of marginal demand. And what they explained was that when an investment bank prices an IPO, it allocates shares mostly to investors who it hopes will be good long-term shareholders. That's kind of the idea. And then when the stock opens for trading, most of those shareholders don't actually sell. They do what they said they'd do and hold on to it as a long-term holding. And so there's an awful lot of frenzy around this because there's been big marketing, it's in the news and so on. And when investors go to buy stock, they can only buy from the flippers, who might be maybe 15% of those who received allocations. When only a tiny percentage of the company's stock is available to buy, the post-IPO price pop reflects this scarcity more than it reflects the true value of the company. And so Andreessen Horowitz argue that just because a price pops, it doesn't mean that the entire equity allocation could have been placed at that higher price. It just means that the few shares that are available are in very high demand for a short period of time. Now, we'll have to see how things go in the world of corporate finance in 2021. I don't think that traditional IPOs will disappear, but I wonder if we start to hear a lot less about SPACs going forward and a lot more about direct listings. Now, in other news, I've been looking at my YouTube analytics and the comment section below my videos, and I see that only around 60% of my viewers actually watch the videos all the way through. So that's you. You're one of those people. And some viewers, what I see in the comments is that a lot of the viewers, they sort of click on the thumbnail and they're excited. They think, oh, it's a Jason Statham film, or, oh, why is the guy from REM wearing a suit? And then they realize that it's not that person, it's me, and that I'll talk about finance. And so then they move on and leave kind of an angry comment below saying, that's not Jason Statham, what a scam. And so luckily for us, at this point in the video, all of those people are gone. It's just us, the real people who care about this stuff. And so I can tell you about the podcast. So last week in one of my videos, and actually a few times, people have asked, is it possible to make the audio available of these videos as a podcast? And I thought, well, that's a good idea. And so I've done that. And so it's up on Spotify and on Apple Podcasts, and basically on all of the podcasting areas other than Google, because it takes longer to get up on Google Podcasts. And so if you want to just listen to the audio, log into your favorite podcasting app and subscribe to this. Now, all of the videos won't go up on podcast because a lot of them are not necessarily suited to that format. So do make sure you come back here to YouTube and visit once in a while. Anyhow, if you like this video and this type of video, you might be interested in my corporate finance book that explains a lot of these types of topic. And don't forget to like and subscribe, and I'll see you later. Bye.